Imagine waking up one morning and realizing that the home you've spent decades paying for is no longer yours, that the equity you've built painstakingly over years has vanished, and the promises of financial security you trusted are gone. For millions of Americans, this is not just a nightmare, it's a looming reality. Experts are warning that by 2026, nearly 40 million homeowners could face foreclosure, drastic losses, or complete financial collapse. The causes are complex, yet disturbingly clear: skyrocketing interest rates, stagnant wages, a housing market that has inflated beyond sustainable levels, and systemic financial pressures quietly mounting behind the scenes. But how did we get here? And why now, more than ever, is the American dream of homeownership teetering on the brink of disaster? To truly understand what's coming, we have to look at the perfect storm brewing in the housing market, starting with the unprecedented surge in mortgage debt that has trapped families in loans they can no longer afford. Over the past decade, the average mortgage balance for U.S. homeowners has climbed to over $300,000, a staggering 40% increase from just 10 years ago, even as household incomes have barely budged. This mismatch between income and debt is creating a ticking time bomb, and when interest rates rise, as they have sharply in recent months, the monthly payments for millions of households jump dramatically. For many, that increase isn't a minor inconvenience. It's the difference between keeping the lights on and losing their home. But it's not just rates, it's also the inflated home prices themselves. Cities across America have seen property values surge to levels that defy the fundamentals of local economies. For example, in markets like San Francisco, Austin, and Miami, median home prices have more than doubled in the last decade, while wages in those regions haven't kept pace. This means new buyers are entering the market heavily leveraged, often taking on loans that exceed 3 to 4 times their annual income. And when an economic downturn inevitably hits, these homeowners will have little cushion to absorb the shock. The federal government and Wall Street have known about these vulnerabilities for years. Analysts have repeatedly sounded alarms that a large-scale correction is overdue, but the mechanisms of financial, policy, and market incentives have delayed the inevitable. Wall Street banks, hedge funds, and mortgage servicers have continued to push new loans, securitize them, and offload risk onto unsuspecting investors, all while everyday families assume that rising home prices are guaranteed to continue forever. But as history has shown, markets don't move in straight lines. In 2008, millions of homeowners lost their homes due to the subprime mortgage crisis, a catastrophe rooted in similar patterns: excessive leverage, financial instruments that spread risk but also obscured it, and a disconnect between asset prices and real-world affordability. Today, the warning signs echo eerily. Refinancing rates are plummeting, adjustable rate mortgages are resetting at higher levels, and the financial buffers many families relied upon during previous crises have been eroded by inflation, student debt, and stagnant wage growth. Even government relief programs, which provided a temporary lifeline during the pandemic, are expiring, leaving homeowners exposed just as lenders tighten their grip. And this isn't a distant or abstract problem. It affects tens of millions of people right now. Consider the fact that over 20% of mortgage holders in the U.S. have less than 5 years of equity in their homes, meaning a modest downturn in property values could instantly push them underwater. Combine that with rising living costs, credit card debt, and a shaky job market, and it becomes clear that the perfect conditions exist for a widespread financial disaster. Beyond the numbers, there's also a human element to consider. Losing a home is more than just a financial setback. It's an emotional and psychological blow, tearing apart families, destabilizing communities, and eroding the generational wealth that so many relied upon to secure their future. Neighborhoods with high foreclosure rates often see a cascade effect. Local businesses close, property values fall further, schools are underfunded, and social instability grows. This is why what's happening in the housing market is not just an economic issue, it's a societal one. To understand why this crisis is accelerating, we need to examine how the macroeconomic environment is compounding the problem. The Federal Reserve has aggressively increased interest rates to combat inflation, yet this policy, while aiming to stabilize prices, has the unintended effect of making mortgages more expensive and reducing consumer spending power. At the same time, global economic uncertainty, from geopolitical tensions to supply chain disruptions, is putting additional pressure on markets, creating a volatile environment where even minor shocks can trigger cascading failures in housing and finance. But perhaps the most dangerous aspect is the illusion of stability many homeowners cling to. People believe that real estate always appreciates, that refinancing options will remain available, or that property values won't decline in their lifetime. While these assumptions have been true for certain periods, they are not laws of nature. Markets are cyclical, and when the cycle turns, the consequences can be catastrophic for those who are over-leveraged or unprepared. So, the real question is not just how many homes will be lost, but how homeowners can protect themselves before it's too late. By analyzing regional risks, loan types, and market trends, it becomes evident that those with adjustable rate mortgages, high debt-to-income ratios, or minimal equity are most vulnerable. Experts predict that the largest waves of distress will hit between 2024 and 2026, coinciding with interest rate resets and declining property values, particularly in markets that experienced the fastest appreciation over the last decade. The magnitude of potential losses is staggering. Estimates suggest tens of millions of Americans could see their home equity wiped out, and many could face foreclosure or forced sales, triggering ripple effects across the financial system. But it's not just a problem for homeowners. Lenders, investors, and even local governments will feel the impact. Mortgage servicers may face increased defaults, banks could incur significant losses, and municipalities could struggle with declining tax revenues as foreclosed properties sit vacant. The interconnected nature of today's financial system means that a housing collapse of this scale would reverberate far beyond individual households, affecting the broader economy and possibly sparking another financial crisis. Yet despite these warnings, many remain complacent, lulled by short-term stability and rising home prices in certain regions. This complacency could be fatal, because once the crisis begins in earnest, it will likely unfold rapidly, with little time for recovery or intervention. For homeowners, the key is awareness and preparation. Understanding the risks, evaluating mortgage structures, and having contingency plans could make the difference between weathering the storm and being swept away. With so much at stake, the coming years may prove to be one of the most pivotal periods in the history of American homeownership. Equity, once considered the safe foundation of financial stability for millions of Americans, is now at the center of a rapidly intensifying crisis. The very asset that homeowners believed would secure their future is turning into a liability under the weight of market pressures, rising interest rates, and mounting debt obligations. To understand the scale of the problem, we need to examine the mechanics of how equity can evaporate so quickly. When home prices plateau or decline, the equity that homeowners counted on begins to shrink. For those who purchased during the housing boom of the last decade, a 10 to 20% correction in home values could instantly render them underwater, meaning they owe more on their mortgage than the home is worth. Coupled with adjustable rate mortgages resetting at much higher interest levels, monthly payments can spike by hundreds or even thousands of dollars, creating financial strain that is often impossible to recover from without selling at a loss. Consider California, where over 40% of homeowners have adjustable rate mortgages. Even a modest 1 to 2% rise in interest rates can push a family's monthly payment beyond what they can afford, forcing them into the difficult position of either defaulting or selling in a declining market. But California is far from the only region at risk. Florida, Texas, and New York, all of which saw explosive growth in home prices over the past decade, now face similar vulnerabilities. Nationwide, analysts are estimating that up to 40 million homeowners could experience a dramatic loss of equity by 2026, and for many, the margin between solvency and financial ruin is razor thin. The economic forces at play are also worth examining. Stagnant wages mean that households are already stretched thin just to cover daily living expenses. Inflation continues to erode purchasing power, and high levels of consumer debt, including credit cards and student loans, leave little room for unexpected mortgage increases. Add to this scenario rising property taxes in many states, and what seems like a manageable mortgage can quickly become unmanageable. And while policymakers and economists debate solutions, the reality is that interventions often come too late or fail to address the structural issues at hand. Temporary mortgage relief programs, government-backed refinancing, or even interest rate adjustments cannot fully counteract a broad market correction when millions of homeowners are simultaneously over-leveraged. Another factor exacerbating the problem is the shift in investor behavior within the housing market. Over the last several years, large institutional investors, including private equity firms and real estate investment trusts, have aggressively purchased single-family homes, driving up prices and reducing supply for traditional buyers. This has created an artificial scarcity, inflating home values to levels far beyond what the average household can afford, and leaving new buyers dangerously exposed when the market inevitably adjusts. For those who believe that owning a home is synonymous with financial security, these developments serve as a harsh wake-up call. Homeownership has long been promoted as a key pillar of wealth building in the United States, but as the system evolves, the risks have grown more complex and less visible. It's not simply about making monthly payments. It's about understanding macroeconomic trends, regional housing dynamics, and the interplay of debt, interest rates, and equity. The data paints a sobering picture. According to recent Federal Reserve reports, nearly 25% of homeowners are considered high risk, meaning they have high debt-to-income ratios, limited savings, or mortgages that are set to reset at higher rates. In combination with rising foreclosures in certain markets, this suggests a potential cascade effect. As defaults increase, banks tighten lending standards, home values decline, and communities face economic and social instability. Historical parallels offer insight into what might happen next. During the 2008 housing crisis, widespread defaults caused home values to plummet, erasing trillions in household wealth and leading to a deep recession. While today's market differs in some ways, regulations are stronger, lending standards are tighter, and housing supply is constrained. The underlying principle remains the same. When too many homeowners are over-leveraged and unable to meet their obligations, a systemic correction becomes almost inevitable. And it's not just financial theory at stake. This is a deeply human problem. Families who once viewed their homes as sanctuaries are now facing impossible choices: sell at a loss, struggle to make payments, or risk foreclosure. The emotional toll of losing a home extends beyond the individual, affecting children, neighborhoods, and entire communities. Vacant properties lead to declining local tax revenues, reduced public services, and eroded neighborhood cohesion, which can take decades to rebuild. Yet, there is a path forward for those willing to act strategically. Homeowners need to assess their personal risk by examining their mortgage terms, equity levels, and overall financial health. Options such as refinancing before rates rise further, building emergency savings, or even downsizing to reduce debt can provide a buffer against the impending storm. For investors, understanding which regions and loan types are most vulnerable is crucial to avoid losses and position portfolios to weather the correction. Policymakers, too, have a role to play. Measures such as targeted relief programs, regulation of speculative investment practices, and incentives for sustainable home ownership can mitigate some of the damage, though no solution is without trade-offs. The critical takeaway is that awareness and preparation are no longer optional. They are essential. As we move closer to 2026, the window for action narrows, and those who fail to understand the risks could find themselves unprepared for the fallout. In essence, what lies ahead is a test of financial literacy, risk management, and foresight, both for individuals and for society at large. The choices made in the next few years will determine whether homeowners can protect their equity or whether millions will experience devastating losses. The complexity of the problem may seem overwhelming, but understanding the interplay between macroeconomic trends, mortgage structures, and human behavior is the first step toward empowerment. It's a reminder that financial security is not guaranteed by ownership alone. It requires vigilance, planning, and adaptability in a market that is increasingly unforgiving. By studying the data, examining historical patterns, and acknowledging the real risks, homeowners and investors alike can navigate the uncertain terrain ahead with greater confidence. Equity is not just a number on a balance sheet. It represents opportunity, stability, and the potential for future growth, but only if managed wisely in a market that is heading toward one of the most significant corrections in modern history. History has a way of repeating itself, especially in the housing market, where cycles of boom and bust often mirror past events with uncanny precision. The lessons of 2008 are etched into the collective memory of economists, policymakers, and homeowners, yet many of the same vulnerabilities persist today, albeit in new forms. Subprime lending, once the primary catalyst of the last crisis, has been replaced by record levels of overall household debt, adjustable rate mortgages, and speculative investment activity that inflates home values beyond sustainable levels. The current risk, however, is even broader. It isn't confined to a specific income bracket or geographic region. Middle-class families in the Sun Belt, retirees in Florida relying on home equity for retirement, and even homeowners in traditionally stable markets now face the possibility of steep losses, if not outright foreclosure. To grasp the potential scale, it's worth looking at the numbers. According to the Mortgage Bankers Association, over 15 million homeowners currently hold mortgages with rates set to reset higher over the next 2 years. Add to that another 25 million homeowners who are already stretched thin financially, and you arrive at the staggering figure of nearly 40 million at risk. These numbers aren't abstract. They represent real families, real communities, and trillions of dollars in potential lost wealth. And it isn't just the homeowners who bear the brunt. Lenders, investors, and even government programs face mounting exposure. As defaults rise, banks could face significant losses, triggering tighter credit conditions that ripple through the economy. Investors who poured into mortgage-backed securities may see sharp declines in value, and municipalities could struggle with lower property tax revenues and increased social service demands as foreclosures rise. Meanwhile, social and psychological impacts are profound. Losing a home can devastate a family's sense of stability and security, disrupt children's education, and erode trust in the financial system. Neighborhoods with high foreclosure rates often see a domino effect. Local businesses suffer, property values decline further, and crime rates can increase as vacant homes multiply. The cascading consequences make this more than a financial crisis. It is a societal one. Experts warn that the tipping point could come as early as 2024, accelerating through 2025 and peaking by 2026, as interest rate resets collide with declining property values. And economic pressures. Homeowners who fail to recognize the warning signs may find themselves with limited options, facing forced sales or foreclosure at the worst possible moment. But understanding the problem is only half the battle. Preparation, foresight, and strategic action can make the difference between financial ruin and resilience. Homeowners should evaluate their mortgage terms, explore refinancing before rates spike further, and consider building cash reserves to weather potential payment increases. Diversifying income sources, reducing discretionary spending, and understanding local market trends can provide additional buffers against the coming storm. For those invested in real estate, recognizing vulnerable markets and loan structures is critical. High-growth regions with inflated prices, high rates of adjustable mortgages, or heavy investor participation are particularly at risk. Prudent investment strategies now could protect wealth and even create opportunities as the market corrects. Policymakers, too, have a role in mitigating damage. Targeted assistance programs, stricter regulation of speculative investments, and incentives to support sustainable homeownership can cushion the blow for those most vulnerable. Yet even with these measures, individuals must take responsibility for their own financial security. Awareness, planning, and timely action are essential. The reality is stark. A housing crisis of this scale will not discriminate based on past success or long-term equity accumulation. Those who are unprepared risk losing everything. The story unfolding is both a cautionary tale and a call to action. The housing market, once the cornerstone of the American dream, is entering a period of unprecedented turbulence. Millions will be affected, yet for those who act with knowledge and foresight, it is possible to navigate the storm with minimal loss, or even find opportunities amid the chaos. Understanding the dynamics at play, rising interest rates, high household debt, inflated home values, and the cyclical nature of real estate, provides the tools needed to make informed decisions. By taking proactive steps, homeowners can safeguard their equity, protect their families, and even leverage potential market corrections to their advantage. The next few years will be a defining period for American homeownership, testing the resilience, adaptability, and financial literacy of millions. Those who recognize the risks and prepare accordingly may emerge stronger, while those who ignore the warning signs could face devastating losses. The message is clear. This is not a distant threat. It is happening now, and the time to act is limited. Forewarned is forearmed. And in the coming years, knowledge, strategy, and prudence will determine who survives the coming housing crisis and who loses everything they have worked so hard to build. By examining trends, understanding risks, and preparing intelligently, homeowners, investors, and policymakers can navigate what may be the most significant challenge to American homeownership in decades. The looming housing crisis of 2026 is set to challenge millions of American homeowners, threatening equity, stability, and the very foundation of the American dream. With rising interest rates, record household debt, inflated property values, and economic pressures converging, up to 40 million homeowners could face foreclosure or devastating financial losses. The ripple effects extend beyond individuals, impacting lenders, investors, communities, and the broader economy. Yet, awareness and strategic action can make a profound difference. By understanding market trends, evaluating mortgage risks, building financial buffers, and taking proactive steps, homeowners can safeguard their equity and protect their families. The coming years will test financial literacy, foresight, and resilience, but those who act with knowledge and preparation can survive, and even thrive, amid one of the most significant housing corrections in modern history. The warning is clear. The time to understand, prepare, and act is now, before it's too late.